Everyone was waiting for the same thing. After the selling, the volatility, the stress rippling through the system, silver was supposed to collapse. That's how this usually ends. That's what the models expect. That's what the headlines quietly prepared you for. A clean break, a decisive flush, one final move down that would reset the market and let everyone breathe again. But that's not what happened. Silver didn't give way. It didn't unravel. It didn't cascade lower the way it mathematically should have. And before you take comfort in that, before you label it as strength or resilience or strong support, you need to understand something critical. This was the moment silver was most vulnerable. If it were weak, this is when it would have failed. If confidence were gone, this is where it would have shown. Markets don't usually hesitate at moments like this. They accelerate. They finish the job. And when they don't, when price just stops, that's not reassurance. That's tension. That's pressure being held in place instead of released. Because a collapse is loud and obvious. Everyone sees it. Everyone understands it. But a market that refuses to collapse when it should, that's quieter, more subtle, and far more dangerous. Silver didn't fall apart. And that, as the first red flag, you cannot afford to ignore. To understand why silver not collapsing is such a serious warning, you first have to understand just how much pressure was already bearing down on it. And why, under normal circumstances, that pressure should have finished the move. This wasn't a mild pullback. It wasn't a healthy correction. It was a structural stress event layered on top of an already fragile environment. And historically, this is exactly where markets fail. The selling that hit silver was not discretionary. It wasn't driven by investors calmly reassessing value or reacting to new information. It was forced, mechanical, and indifferent to price. That distinction matters more than almost anything else. Voluntary selling tends to slow as price falls. People hesitate, bargain hunt, or step aside. Forced selling does the opposite. It accelerates as price drops because every lower tick tightens risk constraints and triggers the next wave. This is how modern markets break. Leverage does not unwind smoothly. It snaps. When a position breaches its margin thresholds, the system doesn't ask for patience. It demands compliance. Risk engines liquidate exposure automatically, without regard for liquidity, timing, or market impact. And once one large position is forced out, the ripple effects begin. Prices move, volatility spikes, and suddenly other leverage players find themselves in violation as well. The math propagates stress faster than human decision-making ever could. Under these conditions, markets don't search for balance. They seek relief, and relief in the context of forced selling only comes from one place: lower prices. Price falls not to reflect value, but to flush exposure. Every drop is an attempt to find a clearing level where enough positions are liquidated to stop the chain reaction. This is why forced sell-offs rarely stop at reasonable levels. They overshoot, because the market isn't negotiating, it's purging. Now add liquidity to the equation, or more accurately, the lack of it. The selling pressure didn't arrive during a deep, well-supported session with full participation. It hit when liquidity was thin, when order books were shallow, and when natural buyers were largely absent. This is the most dangerous possible environment for forced selling. In these conditions, even moderate flows can produce extreme price movement because there is simply nothing there to absorb them. Normally, in a well-functioning market, bids provide friction. They slow declines. They create pauses. They allow price discovery to happen in stages. But when forced selling collides with an empty order book, there is no friction, only air. Prices gap lower not because sentiment suddenly worsens, but because the market is desperately searching for anyone willing to stand in front of the flow. This is why expectations were so clear. Once silver started moving under this kind of pressure, the assumption wasn't that it would stop, it was that it would accelerate. That's what history teaches. That's what the structure demands. Thin liquidity plus forced selling equals collapse. It's not opinion, it's mechanics. And yet, despite all of this, the move stalled. That's the part that should unsettle you. Because nothing in the setup changed naturally. The selling didn't morph into buying. The macro backdrop didn't improve. Volatility didn't subside on its own. There was no surge of organic demand stepping in to declare, this is value. In fact, by every visible measure, conditions were still deteriorating, which raises an uncomfortable question: what stopped it? When markets fail to do what they are structurally primed to do, it means an outside constraint has been introduced. Markets are systems governed by flows. When flows dominate, price follows. The only way to interrupt that process is to alter the environment itself, to change liquidity, funding conditions, or risk tolerances in a way that doesn't originate from traders making choices. This is why the phrase support held is misleading. Support doesn't hold during forced liquidation unless something is enforcing it. Charts don't stop liquidation. Technical levels don't override margin calls. In a true stress event, those concepts are irrelevant. The only things that matter are cash, collateral, and confidence in settlement. The fact that silver did not continue lower implies that one of those variables was suddenly and decisively adjusted. And that is not bullish in the way people want to believe, because if silver had collapsed, the process would have been brutal but cleansing. Excess leverage would have been flushed. Weak structures would have failed. The system would have absorbed the shock and moved on, scarred but stabilized. That's how markets reset. Painful but honest. Instead, the pressure was arrested mid-process. The purge was interrupted. And when you stop the forced unwind without resolving the underlying leverage, you don't eliminate risk, you suspend it. You trap it inside the structure. This is where the danger compounds. A market that collapses tells you where the limits are. A market that refuses to collapse hides them. It creates the illusion of stability while stress remains embedded beneath the surface. Participants relax, not because risk is gone, but because the signal has been muted. And that's why silver holding up here is not reassurance. It's a warning that the system could not tolerate the natural outcome of its own mechanics. It had to intervene, quietly, indirectly, and without fanfare, to prevent the math from completing its work. The selling that should have finished silver didn't disappear. It was interrupted. And interrupted processes in financial systems have a habit of resuming later, often under less controlled circumstances. So when you see silver standing instead of collapsing, don't ask why it's strong. Ask why the system couldn't let it fall. Because markets only prevent their own failures when the consequences of allowing them are worse than the failure itself. And what stopped silver wasn't strength. It was a boundary. And boundaries in markets are never random. They don't appear because buyers suddenly feel confident or because a chart line magically worked. They appear when something behind the price cannot be allowed to fail. This is where we have to talk about the invisible floor, because once you see it, you realize silver didn't stabilize naturally. It ran into a limit the system itself had to defend. In a true free market, price moves until it finds willing participants. If selling is aggressive, price falls until buyers step in voluntarily. That process can be ugly, but it's honest. What happened here was different. The selling pressure lost momentum without being satisfied. It didn't find eager buyers in size. It simply stopped progressing. That's not how forced liquidation ends on its own. When liquidation exhausts naturally, it does so through destruction. Accounts are wiped, positions are flattened, exposure is eliminated. The flow dries up because there's nothing left to sell. But that's not what this looked like. There was no sense of capitulation, no climactic flush, no moment where the market said, "That's enough." Instead, the decline decelerated as if it had hit something solid beneath the surface. That something is the invisible floor. Invisible floors exist when falling prices begin to threaten structure, not sentiment. When further decline risks impairing clearing, collateral chains, or dealer balance sheets. The problem stops being about the asset and starts being about the system that carries it. At that point, price is no longer allowed to search freely. It is constrained. This is why the market's behavior suddenly changed character. Volatility compressed, not because fear vanished, but because risk was capped. Selling pressure didn't reverse, it was neutralized. And that distinction matters. A reversal is organic. Neutralization is imposed. The reason this floor is invisible is because it cannot be publicly acknowledged. If markets openly admitted where intervention becomes necessary, those levels would be attacked relentlessly. So instead, the system operates indirectly. Funding conditions are adjusted. Liquidity is made available. Margin flexibility appears where it didn't exist before. The environment shifts just enough to stop the cascade without announcing that anything has changed. From the outside, it looks like stability. From the inside, it's containment. And here's the uncomfortable truth. Once a market reveals that it has a defended boundary, it is no longer behaving like a free market. It is behaving like a managed system. That doesn't mean prices are fake. It means risk is being redistributed in ways participants are not meant to see. Silver ran into this boundary because it sits at a critical junction. It's not just a commodity. It's a collateral asset, a hedge, an industrial input, and a financial instrument all at once. Stress in silver doesn't stay isolated. It transmits. And when transmission risk becomes too high, the system steps in, not to save silver, but to protect the network around it. This is why the floor didn't come with fanfare. No headlines, no announcements, just a sudden change in behavior. And that's intentional. The goal isn't to reassure the public. The goal is to prevent recognition. Because recognition changes behavior. If participants realize that prices are being constrained, they start to test those constraints. They push, they probe, they look for weakness. And the system does not want that. It wants calm, it wants compliance. It wants people to believe that what they're seeing is normal. But nothing about this was normal. The invisible floor also explains why silver didn't bounce aggressively. If real demand had rushed in, you would have seen urgency, follow-through, expansion. Instead, price stabilized in a narrow range. That's what containment looks like. Not enthusiasm, control. And this is where the red flag intensifies. Because floors don't remove risk. They concentrate it. They prevent resolution. They allow leverage to survive that should have been extinguished. And surviving leverage remembers. It waits. It looks for the next opportunity to assert itself. Markets that are allowed to clear are volatile but resilient. Markets that are constrained are calm but brittle. They appear stable right up until the moment they aren't. And when they finally break, they break harder because the pressure was never released. So when you hear people say silver held support, understand what that really implies. Support held because it had to, not because the market chose it. And that distinction defines everything about the path forward. Silver didn't find a bottom, it found a limit. And limits, once revealed, are not signs of strength. They are admissions of vulnerability. This is where intuition fails most people because we're taught to believe that preventing a crash is always a good thing. That stability is safety. That intervention equals protection. But in markets, especially leveraged ones, preventing collapse often creates a more dangerous outcome than allowing it. And silver is now sitting inside that danger zone. A natural collapse, as violent as it feels, performs a critical function. It clears excess. It forces leverage out of the system. It punishes structures that cannot survive stress. When a market is allowed to fall freely, it finds its true limits quickly. Pain is concentrated, obvious, and finite. The system absorbs the shock and then begins rebuilding on firmer ground. What happened instead was very different. The decline was interrupted before the clearing process could finish. The weakest structures were not fully flushed. The most exposed positions were not all extinguished. Instead of resolution, the system chose containment, and containment always comes with a cost. When you stop a collapse midstream, you don't erase the imbalance, you freeze it. Leverage that should have been destroyed remains alive, but wounded. Risk that should have been priced out remains embedded. The system looks calmer on the surface, but internally it becomes more fragile, not less. This is how instability is deferred, rather than eliminated. Think of it like a fault line. Small earthquakes release pressure regularly. Large interventions prevent movement, until pressure builds to a level that can no longer be restrained. When it finally breaks, the damage is far worse than it would have been through smaller natural releases. Markets behave the same way. By preventing silver from collapsing, the system ensured that stress would not dissipate through price. Instead, it was redistributed across balance sheets, funding channels, and risk models. That redistribution is invisible, but it's not harmless. It tightens constraints elsewhere. It reduces tolerance for future shocks. It makes the system more sensitive, not more robust. This is why calm after intervention is deceptive. It feels like relief, but it's actually compression. Volatility hasn't disappeared. It's been stored. And stored volatility doesn't decay gently. It waits. Another consequence of stopping the collapse is behavioral. Once participants realize, consciously or not, that the system will step in before things get too ugly, incentives change. Risk-taking increases at the margins. Discipline erodes. People don't need to believe in a bailout explicitly. They just need to sense that certain outcomes won't be allowed. That belief alone alters behavior, and over time, it amplifies fragility. At the same time, genuine risk-takers become more cautious. Market makers reduce exposure. Liquidity providers step back. They understand that prices are no longer purely informational. They're conditional, and conditional markets are harder to navigate. That reduction in organic liquidity makes future interventions more likely, not less. So the paradox deepens. The more the system intervenes to maintain stability, the more unstable it becomes. Each intervention raises the floor but lowers the ceiling. Upside and downside become more abrupt. Movements become sharper. And when control finally fails, it fails suddenly. This is why silver sitting calmly after all of this is not reassuring. It's unsettling. It suggests that the system chose to absorb stress internally rather than allow price to express it. And internalized stress doesn't announce itself. It accumulates quietly. There's also a time component that matters here. Intervention doesn't eliminate the need for adjustment. It postpones it. And postponed silver is now in that suspended state. The market didn't clear. It didn't confess its weakness. It was stabilized. And stabilization without resolution is not healing. It's triage. So when you hear that silver avoided disaster, understand what that really means. Disaster was deferred, not defeated. The system chose the path of least immediate pain, not the path of long-term resilience. And that choice carries consequences. Because markets remember stress. They don't forget it. They adapt around it. And the adaptations we're seeing now, tighter risk limits, hidden support, constrained movement, are the fingerprints of a system that knows it came too close to the edge. Preventing the collapse didn't remove the danger. It changed its shape. And shape-shifted risk is often the hardest kind to see, until it suddenly isn't. This brings us to the final and most uncomfortable truth, the part almost no one wants to talk about, because it forces you to reframe what risk actually looks like from here. The real danger is no longer a dramatic collapse. The real danger is what happens next in a market that has been quietly stabilized instead of honestly repriced. When a system steps in to prevent failure, it also draws a line in the sand. Not an official one, not a public one, but a psychological one. Participants begin to infer where intervention might occur again. And once that inference exists, the market is no longer discovering price freely. It's negotiating with an invisible boundary. That boundary changes everything. From this point forward, silver is no longer just responding to supply, demand, and positioning. It's responding to expectations about tolerance. How much pain will be allowed? How much volatility is acceptable? How much stress can be absorbed before something snaps again? These questions don't show up on a chart, but they dominate behavior. This is why post-intervention markets often feel strange. Price compresses. Movements become hesitant. Directional conviction fades. Not because participants are confident, but because they re-unsure which forces are real and which are artificial. The result is a coiled structure, where energy builds sideways instead of releasing vertically. That sideways compression is dangerous, because while price appears calm, positioning does not freeze. Exposure still shifts, risk still migrates. And over time, imbalances quietly reemerge, often in less visible places. Instead of being concentrated in one obvious trade, stress disperses across funding markets, derivatives, structures, and correlated assets. This makes the next break harder to anticipate. In a clean collapse, everyone knows what failed. In a stabilized market, failure becomes ambiguous. Signals get distorted, correlations break down. When movement finally resumes, it often does so violently and without warning, because the pressure wasn't resolved, only masked. Another critical consequence is timing. Intervention doesn't eliminate cycles, it stretches them. The adjustment silver avoided didn't disappear, it was deferred. And deferred adjustments rarely return under ideal conditions. They resurface when liquidity is thinner, when confidence is weaker, or when an unrelated shock arrives to push the system past its tolerance threshold. That's how minor triggers cause outsized reactions. From here, silver doesn't need bad news to move. It needs imbalance. And imbalance is already present. It's just not being expressed through price yet. The longer this tension persists, the more unstable the eventual resolution becomes. This is why the absence of collapse is the red flag. Not because silver is weak, but because the system around it revealed its fragility. It showed that certain outcomes are no longer acceptable, that certain pressures must be contained, and that price alone cannot be trusted to do the clearing. That knowledge changes behavior permanently. Participants become reactive instead of proactive. Liquidity providers demand wider margins of safety. Hedging becomes more aggressive. Volatility, once suppressed, returns in bursts rather than waves. And when it returns, it tends to overshoot, because the system has lost its ability to release pressure gradually. This is the environment where sharp repricings happen. Not slow declines, but sudden gaps. Not orderly trends, but violent adjustments. The kind that feel disconnected from headlines and explanations, because they're driven by internal constraints finally giving way. Silver is now inside that environment. It's not collapsing. And that's precisely why attention is warranted. Stability here is not confirmation. It's a question mark. A pause that demands explanation. And the explanation isn't confidence. It's containment. From this point forward, watching silver isn't about predicting direction. It's about watching behavior. How quickly does liquidity vanish on moves? How abruptly do reactions occur? How sensitive is price to relatively small catalysts? These are the tells of a system operating closer to its limits than it appears. Because markets that are truly healthy don't need to be protected from themselves. They clear, they correct, they move on. Markets that need intervention to remain upright may look calm, but they carrying more weight than they can safely bear. Silver didn't collapse, and that fact alone tells you the story isn't over. It tells you the system blinked first. And when a system reveals its fear, the risk hasn't passed. It's only changed form.